Question number 6C. Consider following information for the security X. Spot price of the equity share is 2000. Exercise price is 1800. Call premium is 300. Type of option is European. Time period of option is 1 year. Rate of interest is 25%. Calculate arbitrage if any. This time, friends, importantly, we have been provided with the information about the European option. Let us answer the question. Answer for question number 6C. In that, write down step number 1, identifying whether arbitrage exists or not. Full stop. In that, write down calculation of minimum premium to be charged so that arbitrage does not exist. Full stop. Let us answer. Minimum call premium for European option. In that, write down spot minus present value of exercise price or 0, whichever is higher. Spot price is 2000. Friends, the premium amount is supposed to be charged on 1st of January, that is today. So we are discounting the exercise price in the current term for finding the minimum premium. Minus exercise price 1800 and it will be discounted. 1800 into PVIF at 25% for 1 year or 0, whichever is higher. So 2000 minus 1800 into 0.8, 25% first year factor or 0, whichever is higher. 2000 minus 1800 into 0.8, that is 1440 or 0, whichever is higher. That comes to 560. So 560 is the minimum call premium which is supposed to be charged. What is actual premium? Actual premium is 300. So write down a conclusion. Actual premium is less than minimum premium. In bracket, write down 300 is less than 560. So arbitrage exists. So the minimum premium that should be charged is 560. Actual premium is less than that. So arbitrage is existing. That is what we understand. So now try to do step number 2 on your own. Calculation of arbitrage in absolute term. Everybody is requested to pay attention. Let me explain you that's how to do answer. See, today's date is 1st of January and year end is 31st of December. We understand that the premium amount is less than what it should have been, so we should buy option. So today we should buy option. It is which option? It is call option. So you buy call option. Now if at all you purchase call option today, then in that case you purchase the right to purchase the security at the end of the year. You purchase the right to purchase security at the end of year. Now as you are going to purchase security at the end of the year, so today what you will do, you will sell security. Friends, we already have understood earlier that if at all you enter into the transaction of only purchasing of the security, that is you are purchasing the right only to buy the security, then in that case it may happen that you end up with the loss. Why? Because suppose today on 1st of January you borrow rupees 300 at the rate of 25% for 1 year. So you purchase right to purchase the security at the end of the year. At the end of the year, the amount that you have borrowed will have the repayment liability 375. Fine. Now spot price of the security at the end of the year can be anything. Suppose the spot price of the security is less than 1800. You take any price less than 1800. What will happen? The option is not worth exercising, and this is the amount of the loss that you have. So entering into sold this transaction is not going to result into an arbitrage. That is what we understand. So what happens? Let's say today we have to enter into the reverse transaction. What? Sale security at the rate of rupees 2000. That is the spot price. Second, borrow security to cover up short position in cash market. Third, buy call option by paying premium rupees 300. Now out of 2000 rupees, 300 rupees is paid for purchasing call option. So what is remaining with you? 1700. So fourth is invest rupees 1700 at the rate of 25% for 1 year. How this 1700 is calculated? 2000 minus 300. So these are the transactions in which you will enter upon on 1st of January. Now based on this, what will happen at the end of the year? Let us see. You have borrowed security So 1, you will have liability to refund the security. You have purchase call option. So second, you will have right to buy security at the rate of rupees 1800. You have made investment. So third, you will have maturity amount of deposit rupees 2125. How this 2125 is calculated? It is 1800 into 1.25. That is the way we will have the maturity amount of deposit at the end of the year. That is everyone. Let me explain you. Now on 31st of December, suppose the spot price of the security is rupees 10,000. I want somebody of you to tell me what would be the profit or loss to the arbitrator. So if at all the price of the security is 10,000, then in that case what will happen? Your maturity amount of deposit is going to be 2125. You have a liability to refund security. Now spot price of the security is 10,000, which is exceeding the exercise price 1800. So in that case, you will exercise your right to purchase the security at 1800. Purchasing the security at 1800, you will refund it. So there is a difference of 325. This is what we understand. We have to see importantly what is our situation. The first thing that we have is liability to refund a security, the person from whom we had borrowed security. We have right to buy the security at 1800. Why? Because we had paid the call premium to buy the option. And we have maturity amount of deposit 2125, 1700 into 1.25. Why? Because 1700 rupees was invested. Now when the price of the security is 10,000, then in that case what we will do, you will exercise your right. That is what's importantly we understand. Whether you will exercise your right, the answer is yes. So what you will do, you will buy the security at 1800 because you have right to purchase at 1800, and you will refund the security. The purchase price of the security is 1800, which is less than the amount that you have, rupees 2125. So what happens at say you have a difference of 325. Now friends, this answer can be cross verified. This 325 is of year end. You discount the same in present value term, that is divided by 1.25. Just see that what is the answer. 325 divided by 1.25. That comes to rupees 260. What is this 260 rupees? It is the difference between the minimum premium and actual premium. Minimum premium should be 560. Actual premium is 300. So that is the way you can have a cross verification of the answer. That is what we understand. My next question to all of you is this, that if at all the spot price of the security is 1800 exact, then what would be the profit or loss for the transactions in which we have entered upon? If the price of the security is 1800, then in that case the option holder is indifferent whether to exercise the right or not. Maturity amount of deposit will be 2125. 1800 is the price at which you will buy the security. Whether you buy from the market or you buy by exercising the option, it will be same. So again you have a profit of 325. My one more question is, suppose the price is, let us say, 1200. What would be the profit or loss? Friends, if at all the price is 1200, then in that case the option holder will not exercise his right. Why to purchase security at 1800 by exercising the right? You will purchase the security from spot market, and in that case you will be able to make higher profit, and your profit will be, I think, 925. Remember that this is an option transaction, it is not a forward transaction, wherein you have to mandatorily buy the security at 1800. It is not like that, friends. What is the maximum price at which you can buy the security? Maximum price at which you can buy the security is 1800. Your purchase price can be reduced, but in no case your purchase price of the security will be exceeding 1800. That is what we understand. So we understand that over here you will have the minimum profit of 325, and your profit may increase if at all the spot price of the security is less than 325. Let us answer the second question. Calculation of arbitrage in absolute term. In that we write today and after 1 year. In the today, write down A. Sales security in spot market at the rate of rupees 2000. B. Borrow security, comma, to cover up short position in cash market. C. Buy call option, comma, by paying call premium rupees 300. Next, invest rupees 1700 at the rate of 25% for 1 year. So these are the transactions for today and after 1 year. In that, write down 1. Liability to refund a security. Second, right to purchase security at the rate of rupees 1800, comma, exercise price being call option holder. Third, maturity amount of deposit rupees 2125. In bracket I am writing 1700 into 1.25. With paragraph write down, calculation of arbitrage. In that, maturity amount of deposit 2125 less maximum purchase price of security 1800. So difference between both of them is arbitrage. $325. With paragraph write down, actual purchase price may fall below rupees 1800, comma, if spot price is less than rupees 1800. Full stop. In that case, call option is not exercised and security is purchased from spot market for a refunding. Friends, the calculation of the arbitrage in that, say, the way we have done the presentation, this that we can do in a different manner also. How we can do in a different manner, I just explained to you. Calculation of arbitrage. In that, spot price it is greater than 1800, equal to 1800 and less than 1800. Like that, so there will be three range. Whether the option is exercised, question mark. In the first case, yes. So what will happen? Maturity amount is 2125 less purchase price 1800. So difference of both of them is arbitrage, and that is an amount of 325. In the second case, you are indifferent. Maturity amount is 2125, purchase price is 1800, so arbitrage is 325. Less than 1800, in that, so the option will not be exercised. Maturity amount is 2125, purchase price is spot price of the security. for the purpose of refunding. And arbitrage is 325 plus 1800 minus spot price. Because what will happen, whatever the amount by which the spot price is less, to that extent your purchase price will reduce and you will be able to make the additional profit. That is the way you will have the additional profit in that case. Friends, over here in step number 1, when we made the computation of the minimum premium to be charged, this answer can be done in an alternative method also. If at all you want to do, it is 2000 is the spot price into 1.25, that is compounded in, that is say by 1 year. So 2000 into 1.25, that comes to 2500 minus exercise price 1800. So 700 is the minimum premium. However, this is calculated in the year end term. So you discount the same in present value term, or otherwise, say again 700, you can make a comparison like this, that 300 into 1.25. That is the way, I think it is 375. So the minimum premium in the year end term is 700 and actual premium in year end term is 375. Like this also you can make a comparison. Or after calculating 700, you discount the same in present value term, it would be 560. And then directly you make a comparison with 300. That is also the method which is possible. However, my suggestion is to go with this method. Why? Because the premium is charged in the present term. So better to calculate the minimum premium also in the present value term.